For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about what matters right now for retirees, pre-retirees, and investors, and where the opportunities are emerging. We'll also talk about the nursing home could cost you everything unless you plan ahead. We'll discuss stewardship, legacy, and faith, planning beyond just money, and the 6-step retirement checklist. Are you actually on track? My name is Jeff Shade. As always, I'm just here to ask the questions, but the words of wisdom and self-advice, they come from Randy and Jake Floyd at Floyd Financial Group. And I'll start with you, Randy. How you doing today?
Doing really well, Jeff. Just happy to be here.
Me too, Randy, and happy to be with you and Jake. Jake, how is this fine weekend treating you, my friend?
I'm doing great, Jeff. Thanks for asking.
Certainly glad to hear that. Hope everybody else is having a great weekend. And we certainly do appreciate you joining us here for Show Me the Money each and every week right here on KSGF. Randy, when people hear about what's happening overseas, we're talking about war, they think it's far away, but what they're really feeling, of course, is the higher gasoline prices, groceries, more pressure on their retirement. So I thought we would connect the dots a little bit today because this isn't just geopolitics. This is really all about people's wallets and the journey towards confident retirement. Right, Randy?
For sure, Jeff. I mean, right now, it seems like every time you drive by a gas station or if you burn diesel or whatever, the price is up a little bit more, right?
Yeah.
So the deal in Iran over in the Middle East, we've got to get solved. I was watching earlier this week I like to watch Squawk Box in the morning. They usually have some interesting interviews and some things on there and some interesting takes as far as what's really happening. And they had some data out there about durable goods shipments and things of that nature. And of course, the oil deal permeates everything. I mean, everything either moves or is a lot of plastic. Things are made of oil. So I think today what really needs to be happening here is I think this conflict is going to have to end in the next, maybe it's tomorrow or maybe it's 6 months, who knows, but it will end. And so I think one of the big things is people need to think about, do I have a plan in place already? If I do have a plan, based on where I'm at right now with what's going on, should I stay the course? Should I adjust? Do I scrap what I've got and start again? And if you don't have a plan, it's not too late to sit with someone to kind of help you figure out what's going on and help you figure out what your next move is. Because again, right now, I would tell people that if you don't need to be buying some extra stuff, just sit tight for a little bit. Let's let this thing pass. I do know this, that there's a lot of money in the system out there, and the uncertainty is what's got people really upset right now, just not knowing where to turn and what's coming next.
Right, and I think what you're saying, Randy, is this isn't just a geopolitics or a war story. It's more about a cost of living story because, as you said, oil really drives the price of everything. Oil, I think, and gasoline prices, it's one of those things where, unlike potato chips in the supermarket, it goes up, but then it comes back down again. Do you think that we're going to see significant decreases once this is all over with again?
So, it's funny you should bring that up because I had this very conversation a couple of days ago. I may have told this story before, but it's all about supply and demand, really. When we have plenty of supply, that tends to put prices down, right? So we got interest rate changes maybe coming and some things like that. But really, deflation, or what would I say, disinflation,
right?
In other words, the slowing down of inflation, I think is probably what's coming. Do I think we're going to have deflation? I don't think so for a while yet. Could we have? Yes, if we see AI improve production in certain areas. If we see oil prices come down, we might see some prices actually come down if we can have increased production and competition.
So let's talk about interest rates. You mentioned them there a little bit, Randy. Because there's a lot of confusion right now. Are rates going up? Are they down? Or are they staying put?
So, we have our good friend. I don't know if he's our good friend yet or not, Kevin Warsh.
Yeah.
That is Warsh. I always remember on the movie Sling Blade where he says, "Son, how far you got to tote that Warsh?" So,
I grew up with people saying that too. Going to wash the clothes and run the sweeper today.
Yeah, that's it. So the interest rate thing, we don't know what Kevin's going to do. I think he will be probably a lot more amenable to what Trump wants than Jerome Powell may have been. I also think that it's important that people understand, again, back to this productivity thing, that interest rates going lower is not necessarily causation for inflation. However, that's what a lot of people are thinking right now. And the reason I say that, if we look back over our shoulder, we had zero interest rates prior to March of 22, and then Jerome Powell over 14 months raised interest rates to 5.25, right? Now it's down to about 3.9 or something like that, I think is what the middle ground is on that. When we had zero interest rates, we were trying to get to 2% inflation. This is pre-COVID, if you remember, and we couldn't get there. And we had zero interest rates, but we had plenty of supply. After we broke the supply chain in 2020, we've never gotten over that because we broke the supply chain down and we also printed money and stuffed it in people's pockets. And that's why we got the hyperinflation we've gotten. But we've never gotten productivity back to where it needs to be. If AI, which I think is the modern day industrial revolution,
Right.
if it can actually make us more productive, I don't think that lower interest rates will be causation for inflation. I think productivity is key.
And Randy, when we talk about rates, we've talked about them in the past. They really matter a lot to retirees. Why do rates matter so much for retirees or even near retirees?
So a lot of people are conservative investors, and they really like when CD rates and things were up around the 5.25%. And I don't know if you've noticed or not, but banks see the handwriting on the wall. So CD rates have started to come down over the last 6 months from 5 down to 4.5 down to 4. Now some are even saying 3.75 or 3.9 is what I'm seeing out there on some of the marquees. So for retirees, they liked having, for a change, some fixed interest they could rely upon. As interest rates change, it does a couple of things, though. Generally speaking, we will say that when interest rates are coming down, that is generally good for the housing market. That is generally good for the stock market. Also, if you own bonds right now and interest rates are coming down, you may get some appreciation in your bonds. Now, I don't want to get too technical here, but basically, bond yields are the opposite of the price of a bond, right? So when interest rates are falling, current bonds are raising their value. When the interest rates are going up, they're generally getting devalued. So interest rates are very critical. We've got to watch them closely, but I do think that interest rates are going to be headed down, certainly if Trump has his way about it.
Talking with Randy and Jake Floyd of Floyd Financial Group, we're talking about geopolitics today and how it affects our wallets. Our number, 417-889-7233. If you'd like to get in and sit down with Randy and Jake and have a little consultation with them, talk about your journey towards confident retirement, it's 417-889-7233. Absolutely no cost and no obligation for that. Randy, you were talking about interest rates, and I was at the credit union the other day, and I was making a deposit, didn't know whether to make it into the checking or the savings account, and I asked the girl behind the counter, well, what's the interest rate in the savings account? She said, it's 0.4%. Is that common these days?
No, I think that's high.
That's high.
No, I would say that savings rates are higher than they have been in the fairly recent past, but yeah, savings accounts, unless you're a squeaky wheel or a preferred customer, generally going to be less than 1%. There are some high yield savings accounts out there you can get through some of the credit card companies and things that maybe pay 2.5 in today's world. They were paying upwards of even close to 4% at one point, but these banks really don't want to get stuck holding the bag on interest rates. So I think you're going to see them continue to lower those, and they really don't have a lot of incentive to bump them up unless we really think interest rates are going to stay high for a while, which they clearly don't, because they have been cutting rates on every side and corner.
Jake, I think we might want to explain to people, too, why is it crucial that the banks don't pay too much interest? How does that affect them if what the Fed funds rate does?
Well, ultimately, the Fed funds rate is the rate at which banks can borrow money from the government overnight to meet their obligations. So a bank operates on leverage. So the only reason that banking is free is because, and free in air quotes, I can't do air quotes on the on the radio here, but the only reason banking is free and doesn't cost you $200 or $300 a month to have access to your money from anywhere is because they're allowed to operate on special rules. So a bank can leverage money in a way that most organizations cannot, especially when it comes to mortgages and certain instruments. So if they loan out too much money, or if they have too much in withdrawals, they can borrow money from other banks at the discount rate, or they can borrow money from the federal government at the Fed funds rate overnight to meet their demands. So there's pretty much no situation where they would want to pay more than the Fed funds rate, because they can get that money from the government Why would they pay you more than that rate? And the answer is, for the most part, they don't. The only exception to that is if they chalk it up to the toaster for opening a new account, if you will, meaning they don't do toasters anymore, but sometimes they'll give you a preferred rate on a small amount of money or something as a way to acquire business. So I guess the long and the short of what Randy's saying is they have zero incentive to pay you more than what the Fed funds rate is. And if they feel like the Fed funds rate is coming down, they could be leaving a lot of money on the table or even costing themselves money.
So if you've got $30,000, $40,000, $50,000 in cash, maybe you've got 6 months worth of living expenses that you want to park someplace. If you're not going to put it in a savings account at the bank and you need it liquid, what would you say is the alternative? Where's a better place to put it?
Well, for right now, I would say this. We always encourage people to have at least 3 to 6 months sitting somewhere that's easily accessible. And so you need to kind of evaluate what that is and certainly keep that on the side, because we don't want anybody to be, if the car breaks, the roof leaks, or the plumbing breaks or whatever, we want to make sure they have access to money to take care of that. But there's places to put money that's still liquid that can give you an interest rate of probably in the realm of 4.5% on certain bonds. Even intermediate and short-term bonds are paying that right now. And then there's other places we can park money that will give us high dividend payouts. There's some high dividend funds out there that are called premium income funds that we do use in some cases because they're still 100% liquid and they offer us a pretty good amount of protection.
Talking with Randy and Jake of Floyd Financial Group, and we're talking about what's happening around the world. I want to talk about some opportunities that exist right now. Let's flip this, because in every environment there are some opportunities. Where should people be looking right now for these opportunities that have been presented because of what's going on in the world?
While interest rates are coming down, interest rates are still higher than they had been for 10 years prior to March of 2022. Bond yields are pretty good. As interest rates come down, those bonds that you currently own will probably be worth more money looking forward. For a while, when interest rates were skyrocketing, bonds were not a good place to park money, because any bond you bought yesterday, people could buy a higher yielding bond today, and that meant that the bond you just bought got devalued. But the opposite is true now. With rates coming down, any bond that you would buy today as rates come down will be worth more. You get to collect the interest payment or the dividend as well as market appreciation. So that's one place to go. And CDs are a form of a bond. But again, the banks are going to be hedging their bet quite strongly going forward. Not so much, though, in these bond funds. We have a lot of opportunity out there for you to collect some interest.
So for the first time in years, conservative investors are finally getting paid again. Let's talk about another opportunity here. Volatility in the market can create some entry points. Can you expand on that?
So, Jeff, there's a term. These people are called quants, right?
Quantitative analyst is what that's short for.
Okay. I didn't know what you were referring to there. So on the edge of my seat, wondering where he was going with this. Okay.
Quantitative analyst, that's right. A lot of these guys are certified financial analysts. And one of the things that we know from history is, about 70% of the time the market is up. And the reason that it is, and a lot of people listening to this will be able to attest to this, for the last 40 years or so, you've probably been funding a 401k.
Right.
So every couple of weeks, or maybe weekly if you get paid that often, every couple of weeks, all that 401k money that you're putting aside goes where? To the market, whether it be the bond market with some of it or the stock market for the majority of it. That money is going to go in there, and that's something that happens through good times, bad times. People aren't stopping their 401k every month because the interest rate changes, right? So as money flows in, there's a limited space for that money to go to, which drives the price of stocks and things up. Now, right now, we're in the middle of wars and rumors of war and high oil prices for the moment. We've been here before. Some of these people listening on here I know will remember the 70s. I remember for the first time I pulled up to the gas pump and I put in $10 worth of gas. I only got 8 gallons. I'm thinking, that is just wrong that I don't get at least equal gallons to my dollars.
Yeah. That would be great today.
Subsequently followed gas wars prior to that.
That's true. Way back before that, we had 17 cents a gallon, gas. And so we know that if we look back over our shoulder from the 80s, the S&P 500 was trading at 104 points in 1982. Today, even though it's down from its high of 7,000, we're at like 6,600 or so. But here's the thing. It's up 66 times since then. Markets tend to go up. We have good times. We have bad times. That's why it's important to have a plan and understand where you are and what moves you might need to make during this volatility. And yes, it will present some buying opportunities and also in some cases some selling opportunities.
So another opportunity that presents itself has to do with energy and defense. Has that ship sailed yet?
Now you're asking me if my crystal ball works.
Right, exactly.
Buddy, I don't know, but here's what I would say. Oil prices are higher. I think a lot of that is speculation and where things are going to go and just fear setting in and hedging in some cases. Defense spending, just depending on what happens here over the next few weeks, months, we don't know exactly where that's going to go. Again, these type of things that we're talking about are situational. They're tactical in nature, and it's something that you have to really be watching day to day and have your hand on the tiller to see what's next.
Yeah, guys, I think if you can tell me whether we're going to have boots on the ground and how long they're going to be there for to the day, then I can probably tell you a little bit more closely. I can prognosticate a little bit better. I would just say that nobody really knows, and if they say they know, they're liars. However, making educated guesses, we know that Trump has a really big axe to grind to get this put to bed quickly because he can't have inflation soar out of control right before the midterms. If he does, he'll get impeached. Probably won't get removed, but he'll get impeached, and that'll create a lot of legal headache for him, and it'll unfocus Congress, and Congress won't do what they're supposed to do, and so he has a lot of reasons, legacy-wise, for him to get this put to bed quickly and for the American people. And I don't think that he has any intention of dragging this out. You may remember that he was a major critic of George W. and his handling of Iraq and having troops there for forever and the forever wars. Again, he was critical of that before it was cool to be critical of that. And so I would just say that I don't think that he has any intention of staying over there. Now, again, I don't know that. That doesn't make me right. I would just say that if we really read the tea leaves a little bit here, and if we understand how Trump operates, you read his book, you understand how he negotiates, I have a feeling we're closer to the end of this than we are to the start. But again, that's speculation on my part.
Good conversation, Randy and Jake. Let me talk to our listeners here for just a moment. If you're listening right now, this is one of those moments where the environment has changed and your plan probably needs to change with it. At Floyd Financial Group, we're helping people adjust to this exact environment right now. We'll show you how inflation impacts your plan, whether you're taking too much risk, how to generate reliable income, and all this is complimentary. There's absolutely no cost, no obligation, no judgment. We'll meet you where you are. Call 417-889-7233 right now and schedule your complimentary Floyd Financial Group retirement review. Don't let a changing world break your retirement plan. Adjust it. 417-889-7233. We're also online at floydfinancialgroup.com. Randy and Jake, let's take a break. When we come back, we'll be talking about the nursing home could cost you everything unless you plan ahead. When our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd, with Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to be talking about the nursing home could cost you everything. So don't go broke in a nursing home.
That's right. Here's a stat that should stop our listeners in their tracks, Randy and Jake. About 7 out of 10 people over the age of 65 will need some form of long-term care in their lifetime. It's not 1 in 10, not 2 in 10, but 7 out of 10. And here's the kicker. Most people have absolutely no plan for how they're going to pay for it. So let's talk about how to protect your life savings before one health event wipes it out. How big of a risk is the nursing home and long-term care cost for retirees right here in Missouri, Randy?
It's certainly one that you really can't afford not to at least think about and address it. So a couple things I would say. Early on, way back in 2006, here at Floyd Financial Group, we did our first Medicaid planning case, and I learned from an attorney up in Kansas City at the time that was helping people up there. And then we really built our business on this a lot, helping people to avoid this. Because like you said, 70% of people are going to need some type of long-term care before they leave this planet. We don't know how long that's going to be. I will tell you that on average, the numbers for a man is about 2.3 years in a nursing home. For a woman, it's a little more than that, 3, maybe 3.5. The reason is when dad gets sick, mom keeps him home as long as she can. But when mom gets sick, there's nobody there because dad's already gone. So it creates this situation where it's been said that long-term care is a woman's issue. And man, it is to a very large degree. So here's the thing. We know that right now, right here in middle America, the last bastion of sanity, as you know I call it,
Right.
I have a gentleman that I help each month because he had no family to pay his bills and that sort of thing. It's $8,600 a month.
Wow.
Is what it is for him to be in there. So you're talking about $100,000 a year, any way you slice it. Now, a lot of people say, well, hey, I have Medicare. That's going to take care of it, right? Well, if you have a Medicare Advantage plan, or if you have maybe a G plan on Medicare, you may get between 20 and 100 days covered if you are rehabilitating. At the moment you stop getting better and you go over to custodial care where you're going to be there and it's chronic and you're not going home, then Medicare is not going to take care of that. So at that point, you need either some assistance from the Veterans Administration, you need some long-term care insurance, or you need Medicare, or Medicaid, I should say, to help you pay for that. So if you don't have any planning in place, what's going to happen is you're going to have to spend your assets down, and that may leave your spouse destitute, your savings drained, investments will have to be liquidated, your entire legacy, if that's important to you, could be wiped out. But I will tell you this, with proper planning, we can make a big, big difference.
Okay, so you used to do a seminar called 4 Ways to Pay, and the first one was just, you're going to write the check right out of the hip pocket. And as you say, most people are not plumbed to do that. There's also, as you said, Veterans Administration benefits, but there are 2 other ways to do it. Can you expand on those a little bit?
Sure. So the VA benefits are something that's called aid in attendance, and it's something that you can talk to your veteran service officer and learn more about those sort of things. There's qualification points for all of these things, and it's something you need to plan ahead for to tap into. But if we look at the options beyond veterans benefits, it's going to be some type of long-term care insurance. And for most people, long-term care insurance is something that's very hard for them to afford as well. And typically speaking, when you buy a long-term care insurance policy, the old standard type that you think of, you buy a daily benefit. So in today's world, we know that we need $250 to $300 a day in benefit if you want to cover the full cost of it. Now, you may not need to. If you've got strong savings and you can draw income from and maybe Social Security, you might be able to have $200 a day, and that would help cover you for what you need. But buying that, you have to qualify for it, number one. So if you don't have your health, you can't buy it at any cost. And then the other thing is, if you build in an inflation fighter, the price of that stuff goes up, 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 and it can price you out of the market when you need it most. Now, I will say this. There's non-forfeiture laws in place now that say, hey, if I've paid on this for 15 years and I can't pay anymore because the price gets too high, if you fall ill, they have to, in the state of Missouri, pay you at least the benefit back that you've paid for if you let it lapse. But again, I think the thing about long-term care insurance is it is something that is a traditional type is going to change and be costing you more and more each year. Now, there are some life insurance contracts out there that do have chronic illness benefits for long-term care and home health care, that sort of thing. But again, you've got to be able to qualify for those things. And many times, by the time people get to 65 or 70 where they're thinking about this, they can't qualify.
So, Randy, I'm sure that there are a lot of people out there listening to the program today saying, well, I'll just spend down my assets or I'll transfer them over to somebody else, the kids or someone like that, and then I'll just go on Medicaid, and Medicaid's going to pay for the nursing home. Doesn't exactly work that way. I understand that you do have a strategy in which you can save the family farm from the nursing home. So I'll leave it at that and let you take it from there.
Yeah. So prior to about 1980, that was the case. We could transfer assets today, go apply for Medicaid tomorrow, and they would do that. But then this funny thing happened. They put what's called a look-back period in place. And from 1980 through about 2005 or 6, that changed over and over and over. And now what it amounts to is you have to do a transfer of assets 5 years in advance. Well, that's okay, I guess. And what people thought was, I'll just give all this to my kids.
Right.
Well, the problem is once you give it to your kids, you have to wait 5 years before that takes effect because they have to give it back. Well, what if your kids go spend the money?
Yeah.
Ouch. That's a problem.
Right.
But anyway, today what we do is we do Medicaid Asset Protection Trusts. It's a type of irrevocable trust that once the assets have been transferred over there after 5 years, Medicaid sees them, knows they're there, but they are off the table. Now, there's certain types of accounts and things that you can't transfer into trust, like IRAs and some things like that. But suffice it to say that the MAP trust, we call it, Medicaid Asset Protection Trust, is something that really everybody should look at for a portion of their assets. Now, not everything. You need to have your checkbook in your name so you can pay the bills and live month to month. But it's certainly something that you need to think about and look at and explore, because I think personally everybody should have an irrevocable trust. And don't let the word irrevocable scare you to death. There's parts of it that are changeable. The parts that you would want to change are still available to change.
Talking with Randy and Jake of Floyd Financial Group, we're talking about saving the family farm from the nursing home and how much a nursing home actually costs here in the last bastion of sanity. As you said, Randy, it can be between $8,000 and $9,000 a month. Most people just not plumb to do that, but it is something that's going to affect about 7 out of 10 people. Again, our phone number 417-889-7233. It's 417-889-7233. If you've got questions or you're looking to have a strategy to protect your assets from the nursing home, we can certainly help you out with that. All it takes is that phone call. So what mistakes do you see people making all the time, Randy?
Well, people want to believe that, number one, it's not ever going to happen to them. Or I have people come in, I'm never going to a nursing home. So I had one lady that said to me, she said, well, he has a plan for me. I said, really? What was that? She said, well, he told me that if something happens to him where he gets really sick, I-44 is just over there a little ways. We got a wheelbarrow out there. And
oh, my gosh.
He told me to put him in it and put him in the middle of I-44.
Oh, no. Hope that wasn't a real plan.
I said, well, that's a plan.
Yeah, that's one plan right there. But, hey, this is not something that you want to really think about. But what are some of the real mistakes that people do make?
Yeah, number one, people think about this too late. Gifting needs to be done ahead of time, but you need to do gifting with strings. Now, what I mean by gifting with strings is if I just give something outright to somebody, I don't have any control over getting it back if I need it, because I have this 5-year look back thing that says, hey, if you give something away within 60 months and you end up in a nursing home, you got to bring that back. So I have to make sure that I put money in trust. You know what the old saying, Jeff, put not your trust in money, but always put your money in trust.
That's right.
So make sure that you've thought about this ahead of time and don't wait. You say, well, hey, I feel fine today. So did my buddy that's in the nursing home, and they found him laying beside his car.
Right.
So did my brother-in-law about 6 months ago. We don't know when a stroke or something like that may hit us. So make sure we get the 5-year clock started. The other thing I would say, too, is we need to be sure that we're thinking about, if I end up having a problem like this, what happens to my spouse? How does that affect them? And so people need to keep in consideration that really right now is the best time to think about this and make some decisions right now so that you can protect your spouse, protect your legacy, and just get this where you can kind of set it off to the side and get it off your plate.
And Randy, a lot of people think, well, I'll just do this myself. I can figure this sort of thing out. That's a big mistake. This is not something that you want to do on your own, is it?
No, because here's the thing. While it looks really simple, there's some complexity to this. The burden of proof of everything is placed on you to prove it to Medicaid. End of story. And so if you don't know how to do that and you can't do that, then there you are. You're up a creek without a paddle.
Let's talk about how Floyd Financial Group can help people solve this problem. Elizabeth is right here in the building. How does she help us with this?
So Elizabeth is an estate planning attorney and has lots of experience with elder law and can help people set up these map trusts and things to help them avoid losing the family farm, losing maybe some rental property, losing something other than your residence if you have property that way, and also protecting the monies that you have that you plan to pass on to your heirs, money outside of IRAs and that sort of thing. She can definitely do that. She's been doing it a very long time. I think I alluded to the fact that even before she was an attorney back in 2006, she and I did our first case together with the attorney in Kansas City and got that worked out. So we're 20 years down the road in helping people not only get ahead of this, but also if they haven't done the planning and try to save as much of their assets as possible. And I will say this, if you haven't done it and you're in crisis right now, somebody's in a nursing home or about to go there and you're afraid of losing your home, your farm, all your money, it's not 100% too late, especially if you've still got a spouse alive. There may be, well, not maybe, there's lots of things we can do to protect your assets.
So, Randy, if someone listening to the program today is 70 years of age, they think they're going to need a nursing home, but there's this 5-year look-back period. They don't know if they're going to need a nursing home at 75 or 80 years of age. Should they begin to transfer those assets now? And what if they've transferred all the assets in 5 years and they don't need the nursing home till they're 80, or they're never going to need it at all? Then what happens?
Well, so the good news is nothing happens. I mean, if something happens, you're taking care of it. If nothing happens, you're still taken care of. And if we need to get access to some of that money down the road somehow, we have methods to do that won't breach anything in Medicaid law.
Talk with Randy and Jake Floyd Financial Group, and we're talking about the nursing home here and the fact that 7 out of 10 people are going to need some sort of long-term care. Does this also apply, this strategy, for assisted living as well as full-on nursing care?
So let's be clear about that. In the state of Missouri, Medicaid is not really a good tool for assisted living. It's mainly going to be applied to skilled nursing, and sometimes that's memory care. Sometimes it is not memory care, but it can be as well as skilled nursing. Those are the things that it actually helps with. So I want to be clear on that, but that's a really good point, Jeff.
Randy and Jake want to talk to our listeners again. That 7 out of 10 number should be a wake-up call for you, because statistically, most people listening right now are going to be in that 7. If you don't have a plan, the system has one for you. It's called Spend Everything You've Saved Until It's Gone. Well, at Floyd Financial Group, we help you flip that script. We'll show you how to protect your assets, your spouse, and your legacy before it's too late. So call right now for your complimentary Floyd Financial Group Retirement Review and Asset Protection Review. Our phone number, 417-889-7233, 417-889-7233. You can also find us online at floydfinancialgroup.com. All right, Randy and Jake, let's take another break. When we come back here on Show Me the Money, we're going to be talking about the 6-step retirement checkup. Are you actually on track? When our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Randy Floyd, Jake Floyd, and Jeff Shane.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about the 6-step retirement checkup.
And Randy, the markets have been all over the place lately, and I think a lot of people listening are wondering, am I actually on track for retirement, or just hoping that I am? I'd like to walk through a simple 6-step retirement checkup that could be a wake-up call for a lot of people. So let's start with the most basic question, Randy. How do you even know if you're on track? Where do you start?
So if you're not retired, or if you are retired, it's a couple of different things to look at. But let's talk about if we're pre-retirement. Let's look at where we are and make sure we have a plan to get where we need to go with budgeting and reasonable investment advice and that sort of thing. But here's what I would say. Most people, as a rule, don't actually know if they're on track or not, because they haven't really sat down with somebody to say, hey, what does this chunk of money really mean to me? And they sometimes don't even know, what is my actual current savings? Maybe I've got an old 401k over here and a new one over here. Maybe I've got a brokerage account and I've got savings accounts. There could be lots of things. They also don't really know how to factor in inflation and look at what really might need to be there for them in future needs. And then some people say, I'm going to retire early, so I'm going to be really ready to go out and do a lot of things the first 5 or 10 years, and then maybe not so much later. And then also they don't know really what their potential longevity looks like. You know, the older we get, Jeff, the older we tend to get.
Right.
It's the thing that happens. So really what we need to do is make sure that people have sat down with somebody that's done this before. You know, Jake has probably helped well over 1,000 people retire at this point, and everybody's situation is a little bit different. There's no one plan fits all.
So most people don't actually know. They're guessing. They need to compare current savings, future income needs, time remaining. If you can't see it clearly, you can't plan it correctly. Okay, if someone runs the numbers now, Randy, and realizes, hey, I am behind, what's usually the reason for that?
Yeah, well, maybe they haven't saved enough. Maybe they didn't start soon enough. So now we got to figure out a way to turn up the volume on that. Maybe they're not taking enough risk, or maybe somebody has taken too much risk and bought Rivian back a few years ago, and
yeah,
hopefully not. And then also we have to look at, are we spending too much money right now? Can we trim some things back? Not that I'm trying to cut anybody's fun off, but at some point, if we're going to retire, we have to think about building us a nest egg that's going to last us and keep the wolf away from the door for maybe 25 or 30 years.
Right. Underperformance isn't always the investments. It's often the strategy. So this is where people get nervous, Randy. What do you actually do if you look at the numbers and you say, I am behind, but I need to do something? Where do we start with this?
Yeah, so we look at what their budgeting may be and really what their lifestyle is going to be like, what they tell us they are planning to do and what they want to do in retirement. And then what we do is really we reverse engineer the process, and maybe they need to save more, maybe they need to work a little bit longer, or maybe they need to adjust their expectations just a little bit looking forward.
Everyone wants better returns, Randy, but nobody wants more risk. Do you think that that is a realistic way to think about things?
Yes, Jeff, everybody wants better returns, but they don't really necessarily want to take more risk. And this is really important as we get to the final stages of retirement, maybe the last 5 to 10 years out. We need to make sure that we are getting good returns on our money, but we're not taking too much risk. One of the things that I always find interesting as we look at retirement planning, if people have been doing it a long time, and let's say we get an average return of 7.2%, that means that every 10 years our money is going to double. And what's really interesting and fascinating to watch is how when people get within 5 or 10 years of retirement, how much more money they accumulate most times by just being careful and planned and staying invested, right? I'm just telling you that the compound effect that Einstein talked about was definitely the eighth wonder of the world. But we got to make sure we're allocated properly, that we're looking in the right spots to make money. All markets cycle, and certain investment categories, whether it be oil and gas to energy to finance to consumer staples, all those different segments of the market are always rotating in and out of favor. So it's important that you have somebody that's watching what's going on. In some cases, we need to use some annuity contracts to get people guaranteed income. Everybody's take is a little bit different, and what we're here to do is to develop a portfolio that makes sense investment-wise, but also keeps people comfortable as well from an income planning perspective, as well as just feeling good and sleeping well at night.
Right, and a lot of people have 401ks, they got 403bs, they've got IRAs, and they take a look at those and they say, I should have contributed more to those. Is there a way that people can catch up on contributing to those?
Oh, yeah. I mean, there's rules that put into place where we get an extra $1,000 on IRAs after we hit past age 50. And then in your 401ks, I mean, it's possible to save as much as $32,000, I think, now in your 401ks at work. So in 403bs, that sort of thing. So, yeah, there's ways to catch up. And sometimes it depends on the age of people. I have some people that are going to work to age 70, and many times they will turn on Social Security at 66 and a half or 67 is what most people's retirement age is now. And they will actually fund more into their 401k and use the extra Social Security income to live on while they fund more trying to build out that tax-deferred retirement.
Talking with Randy and Jake Floyd of Floyd Financial Group, and we're talking about catching up on your retirement savings. You've taken a look at your accounts and you realize, I'm just a bit behind. What am I going to do here? Again, if you'd like to have this conversation in person with either Randy or Jake, 417-889-7233 is our telephone number. You can make that call right now if you want. Leave your name and telephone number. Ashley will call you back during the week and set up that appointment for you. Again, there's no cost, no obligation. It's just a casual conversation. 417-889-7233. We're also online at FloydFinancialGroup.com. So, Randy, let's continue our conversation here. This is where it gets real: income. How do we turn savings into a paycheck?
Right. This is the $64,000 question, right?
$128,000 with inflation.
Everything is about timing. When do you take Social Security? A lot of people come in and say, what's the optimal time to take Social Security? And we have to say to each person, tell me about your health. Tell me about what you're feeling right now about work. Are you happy at work? Are you not happy at work? Because, we have dollars and cents, but then we also have the emotional side for people and their spouses. So when do we take Social Security? If you could tell me the last day you take your last breath, I mean, I could tell you exactly how to maximize it, but we don't know that for sure. So taking that income, if we are one of those people that have the ability to have a pension, or we have one, I think only about 16% of people in America have the availability of a pension. It might be that we take a pension early on, wait on Social Security for a while. Maybe we have investments out there that we got some fixed stuff where we can pull some fixed interest off of them for a while. There's just many ways to generate and look at taking income. The pension plans, sometimes they make sense to turn on at work, and sometimes they don't. It just depends on what they're willing to pay, because some pension plans are very lucrative, but most are actually not that lucrative. We're better off to take the lump sum and invest it and pull an income, because once we turn on a pension, if there's a big nest egg out there, and we see these pension plans sometimes $500,000, sometimes almost $1 million out there, and they'll say, we'll give you $50,000 a year in exchange for your $1 million.
Mm-hmm.
And I'm like, I don't think I like that.
Yeah.
Because all I got to do is get a 5% return,
Right.
and I get to keep my $1 million and have my $50,000, right? So pensions can be great, but we always need to evaluate them and see what makes most sense for the client. Investments, structured withdrawals, maybe it's annuities, maybe it's a bond laddering system, maybe there's somebody that belongs in CD and money market accounts, or maybe just a bond fund somewhere. But again, we want to work out a plan, not just hope that it will all work out. We want something that's going to be reliable and predictable, because let's face it, the bills come every 30 days.
A lot of people look to annuities to create a paycheck, Randy. Do you think that that's a realistic way to do it?
You know, there's 3 basic types of annuities out there, and the one I would tell people to kind of stay away from is this thing called a SPIA. That's a single premium immediate annuity. There are uses for those, but not generally for income. And this is many times how a pension plan is set up through a company. An annuity contract is set up, and basically they're going to get paid out for the rest of their life, and they get a max payment that way. What we want to look at is some of the annuities that allow us to track an index like the S&P 500 and get a share of those gains. Some of these annuities that we set up, they're called fixed index annuities. While we get a share of the gain, we don't have to stand the losses, because once a year or once every couple of years, we get to lock in all those gains. And that really helps us to hedge against downtimes, because here's what happens. Generally speaking, when the market moves, it's going to move double digits positive or double digits negative. And so if we can get the lion's share of that upside and sock that money away, even when we have the downturn coming along, that annuity protects us on the downside. So if we're down 20% in a year, you're going to be down 0. Now you've taken your income, but then when the market rallies back, you're going to be able to recover and probably even get ahead of the game. And so that's how we use annuities to help give us some predictable income streams. Sometimes we could even set up enough into the annuity contract that it will fund all the basic needs for someone. And then we have market and other buckets of money that we will use in the future to hedge inflation.
Talking about the 6-step retirement checkup with Randy Floyd Financial Group. Are you actually on track? So, Randy, the last step, risk. This one seems huge right now. Why is that?
Because everything is crazy.
That's right. To put it in a nutshell, to make it simple, yeah.
Every day we wake up and the social media thing is just crazy. If you want to go out and find anything about anything and find somebody in favor of anything that would normally be wild, you can find it. I mean,
Right. As you said, social media has really uncovered the number of people out there who really just have too much time on their hands, who might be living in their parents' basement or something like that. But people have some crazy thoughts out there. And if you want to find out what people are up to, just look at social media. But risk is really huge right now. And most people, do you think, are they taking too much risk without realizing it?
I will say this. I think that people, I don't know if they're taking too much. Sometimes they're taking not enough, and sometimes they're taking too much. And I think what it really amounts to is there's 2 parts to risk. Risk is, okay, what is my tolerance for risk? In other words, what am I willing to accept? If I got $100,000, is my tolerance, hey, when it gets to 80, I'm ready to come shoot you if you're the advisor, or is it 70, or is it at 95,000 they're ready to come shoot us? And then the other side of that is, how much do I want to make? Am I happy making a 3 or a 4% return, or do I want to make a 10% return on average, or maybe 8 or 9 or something like that? Or when the market's really up, do we want to really be up? So that's the risk tolerance question. That's how tolerant am I of my balance fluctuating? Now, the other side of that is, what is my risk capacity? What's my ability to take risks? In other words, do I have a lot of extra money where I can take a little bit more risk and it's not going to affect my living day to day? Or do I really need to make sure I wring every cent out of every last dollar? So there's risk capacity and risk tolerance, and they're 2 different things. So the biggest thing that I would tell people is this: if you're getting close to retirement, or if you're in retirement, you need to protect against this thing called sequence of return risk. Sequence of return risk basically says this: we don't know next year what the market's going to do. It may be way up or it may be way down. We need to be sure that if we have a way down market, that it doesn't damage you so bad that you cannot recover and get back to where you can live. And if you have one of those situations where you're retiring into an upmarket, let's make sure that we're able to capitalize on that and store away a few extra dollars for when those times are bad. So the goal isn't necessarily just to go out and throw caution to the wind and try to make all we can. As one guy said, let's not lose the war by winning this one battle.
And here's the reality, Randy. I think most people listening right now don't actually know if they're on track. They hope that they are, and hope is not a retirement strategy. So that's why we're offering this complimentary retirement review here at Floyd Financial Group. We're going to show you exactly where you stand, what's working, what is not working, what's missing, and how to fix it. No pressure, just clarity. This could be one of the most important meetings that you'll ever have, and it's not going to cost you a dime. No cost, no obligation, no judgment. If you would like to have that meeting, 417-889-7233 is the number to call. You can do it right now and schedule your complimentary retirement review. Once again, it's 417-889-7233. We're waiting for your call. As I said, no cost, no obligation, no judgment. We'll meet you where you are. Don't guess about retirement. Know that it's working for you. Randy and Jake, let's take a break. When we come back, we're going to be talking about stewardship, legacy, and faith, planning beyond just money, when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Randy Floyd, Jake Floyd, and Jeff Shea.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to be talking about stewardship, legacy, and faith, planning beyond just giving your money.
And Randy, here in the Ozarks, people work hard, they save diligently, and they care deeply about their families and their faith. But when it comes to retirement and estate planning, I think a lot of folks are asking a bigger question. Not just how much do I have, but what's it all for? So let's start with a bigger idea. What does it mean, Randy, to be a good steward of what you've been given?
Sure, that's a great question. Actually, at church, over the last 16 weeks or so, I've been giving a class called Money Wise. And one of the things it talks about is being a good steward of what you have, and the fact that I believe, and this course talks about the fact that we are blessed so that we can be a blessing to others. It's not just to hoard it all for ourselves.
Right.
And hopefully that we can pass on that thought process that we can help others with our money. Yes, we want to help ourselves, and yes, we want to enjoy life and be able to live life to the fullest. But at some point in time, too, it gets beyond just that. You know, money is a tool to help others. And I'll tell you, one of the things that I love as I've gotten a little bit older here, I don't live hand to mouth like I used to when I was first married and we were punching into the calculator if we could have an extra loaf of bread or not, that sort of thing, is what we're able to help people and provide things for people that can't help themselves and give them a hand up, right? So I think that stewardship is just about realizing that everything we have comes from the Creator. Yes, we had to work for it, but everything, we can't add 1 second to our life. And it's not just about building wealth. It's about honoring what we've been given.
Right. You're managing what's been entrusted to you. You're not just owning it. And as I've said many times, and sometimes to people who do this, they work so hard to just accumulate more money, more money, more money. And I've said to them, I've never seen a hearse towing a U-Haul. You just can't take it with you. But still, there are people who have that mindset. Why do you think some people think that way, Randy? It just doesn't make any sense to me.
Well, one guy told me they didn't get enough Kool-Aid when they were little.
Okay.
That must be it.
So I'm going to take all this money going to heaven and I'm going to have enough money for Kool-Aid? Still doesn't make any sense.
One of the things that this class called Money Wise talks about is the fact that we have assets under management. And in the financial world, we talked about AUM, assets under management.
Right.
But we're talking about in a different sense here from a spiritual perspective, that yes, we've been given these things to manage. And if you remember in the Bible, it talked about the parable of the talents, right? Where the 3 guys were given stuff, 2 guys invested and 1 guy buried it. It was the guy that got in trouble, right?
Right.
We need to share and we need to make sure that we're passing along those values to our children, our legacy. So I think that's very important.
Money is just a tool, as you said, to provide, to protect, to bless others with it. It's not just about building wealth, but it's about honoring what you have been given. We're temporary managers. We're not permanent owners. A lot of people think estate planning and legacy planning are the same, but from a faith perspective, they're really quite different, aren't they?
Yeah, so we're talking about estate planning. That's the legal entities, the documents that we draw up to support us while we're here on earth still, and then how things get passed on to our heirs. On the legacy side of things, and that becomes more, what values do I pass down? What does money represent to me? Are you encouraging responsibility or dependency? Are you supporting causes that reflect what your beliefs are? I think that's very important that we put our money kind of where our mouth is. And I will tell you this too, Jeff. I have to say that one of the things I enjoy most in life today is being able to give and support causes that I believe in.
So in short, Randy, estate planning is a legal structure. It's wills, trust, and tax efficiency. But legacy planning, that's something different. It's spiritual and family impact. What values are you passing down? What does your money represent to you? Are you encouraging responsibility or dependency, as you said, and are you supporting causes that reflect your beliefs? Estate planning passes down assets. Legacy planning passes down values. And I know that there are some people listening out there. I've got a friend who has established a scholarship with some of the money that he has to ensure that their underprivileged kids who want to get ahead in life have the opportunity to pay for an education so that they can do that. What happens when people ignore that legacy side, Randy?
Well, all too many times it does create problems within the family. We're going to call it creating division. Sometimes things get misused, and maybe what mom and dad would have intended gets lost pretty quickly. I think it's less prevalent today, but I remember 25 years ago when I was getting this business kicked off and just kind of new to this, mom and dad really didn't tell the kids much about anything that they had. And I think today we're a lot more open with what we have, and that's a good thing. And it's also something that has helped people to be proactive in knowing they need to plan for what happens, because they don't want the kids to fight, right? Nobody wants their kids to fight. But here's the thing. It's funny, when a little bit of money gets involved and death gets involved, things can get pretty messy pretty quick if people haven't figured out what's going on there and they don't have a plan in place.
Right. I've seen a lot of families destroyed by money, and that is just so very unfortunate. Talking with Randy Floyd here of Floyd Financial Group, we're talking about the spiritual side of money and the fact that we don't actually own it. We're just stewards of those dollar bills. Randy, let's talk about taxes, but also giving, because for a lot of people here, generosity is really a big part of their faith.
Yeah, for sure. I mean, it's something that we believe in wholeheartedly, and we tithe, we give to missions, and then we also sometimes just go looking for people to bless. It's kind of fun to do. But, smart planning will reduce taxes, and that money can go to help other causes, tools that align with our values, things like charitable trusts that can be set up where, you can give money away, draw an income from it while you're still alive here, and then it goes to whatever you would want it to go to at the end through that charitable remainder trust, they call it sometimes. Donor advised funds, there's structured giving strategies that you can do. And like we talked about already, through the charitable trust, there can be income potential there, tax efficiency where you get a tax write-off. And today you can still give away up to 50% of your income and tax deducted if you give it to something that's a creditable charity like a 501c3 organization and that sort of thing.
Right. And almost every week I'm at Goodwill or Salvation Army or someplace like that. They always ask, do you want a receipt? And I always tell them, no, I'm giving out of the goodness of my heart. I mean, I could take the receipt and deduct it off the taxes, but with the standard deduction the way it is today, the receipts really don't mean much of anything, do they?
No, I mean, for most people, the standard deduction being so high, they aren't going to give enough to get into that. It used to be, before the last major tax law change, under the Secure Act, everything we gave was above the line before deductions, but now it falls in as part of that deduction. You have to go north of your personal deductions before you get any additional benefit.
Right. And for married filing jointly, I think that deduction is somewhere over $30,000. So unless you're giving over $30,000, $31,000 in charitable contributions, it really doesn't mean anything. But that also includes interest on your home, any number of different things too. So, and I think something like 80% of people do not itemize these days, but that is something that may change when the Trump administration is done. Let's shift to elder law now, because this is about protecting your family while you're still here. And I understand Elizabeth here in the office specializes in elder law.
Yeah, she does. So things that everybody needs to think about and have. Number one, whether you go out and you do a trust or whatever, but you need to think about, everybody needs to have a will. Everybody needs to have a durable power of attorney for finance as well as one for medical. Very important that you have those so that you know who's going to be making your decision, who might be pulling the plug on you or not.
Right.
That sort of thing. If you get to that point, the thing that's nice about having all these things done up ahead, even pre-planning a funeral sometimes is a great thing. I know when my mom passed, we did not have a pre-planned funeral. And so my sisters and I, we walked into the funeral home down there, and they take us back to look at caskets, and right up there in a big banner, it said Mom in about 2 by 2 foot letters up there, and there was a $10,000 casket right below it there, and both my sisters just broke out crying. It was just
Right.
It was unreal. I didn't think that was very fair at the funeral home, by the way. But anyway,
Yeah, where's the unfair trade practices in the funeral?
Yeah.
what? So from a faith perspective, it allows people to be able to grieve, and they don't have to make all these sorts of decisions. And they also know then that mom and dad got exactly what they wanted because they did the planning, right? So it prevents, again, maybe kids from fighting and that sort of thing. So I would say this, the best thing that you can do for your family is to do these things. Plan ahead so that they don't have to try to figure out what was important or what mom or dad would have wanted. And sometimes brothers and sisters have different ideas on what that would be. So let's head that off at the pass.
Right, and pre-planning like this is one of the most loving things that you can do for your family because, of course, when someone passes, there's an element of grief, and the last thing that you want to do is what you had to do, that is go into a funeral home and make all these decisions. So, Randy, how should someone listening right now think about all of this money and stewardship and so forth? How should they be thinking about this in a simple way, do you think?
Yeah, I think that overall, we want to live while we're here and make sure that we get the use of the assets and things that we worked a whole lifetime for. We want to make sure that we've thought about what happens when I'm no longer here or what happens if I become incapacitated, and make sure that we've set up all these things. And I grew up in a really small town, and everybody knew everybody, and if something happened, everybody was willing to help.
Yeah.
Well, in today's world, even though we have social media and all these things where everybody's talking all the time, we're probably less connected than we've ever been. And the law today, I mean, we need to have these legal documents in place. For the most part, nobody's going to help you because they're afraid of the potential liability they're going to have.
Right.
So we need to have these things in place. And then you know that whatever happens, it's all going to be good. It's going to get worked out. And again, for people of faith, we know that this is not our final dwelling place.
Right.
And if we get all that stuff laid to rest, we know that we've done our due diligence here on earth. And I think that's a wonderful place to be, to know that it's all going to work out.
Well, I think the takeaway from this conversation, Randy, is that retirement planning isn't just financial. It's spiritual, it's relational, and it is generational. You're listening right now. You've worked hard for what you have. The question is, are you being intentional with it? At Floyd Financial Group, we help families align their financial plans with their values. We'll walk you through what your current plan actually does, how to protect your family, and how to create a legacy that reflects what matters most to you. No cost, no pressure. And if you'd like that, call 417-889-7233 to schedule your complimentary Floyd Financial Group retirement and legacy review. Again, it's not going to cost you a dime, but it could be the most important thing that you will do. Don't just pass down wealth, pass down wisdom, purpose, and faith. And again, that phone number, 417-889-7233. We'd love to talk to you. And of course, we're online at floydfinancialgroup.com. Well, Randy and Jake, before you know it, we're out of time. And that's happened again this week. So for Randy and Jake Floyd, I'm Jeff Shade, wishing you a great weekend. Thank you so much for joining us this week. Be sure to join us again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.